Well, good evening and welcome to the live event on the 23rd of March 2021. Martin North from Digital Finance Analytics here. Great to have you on once again. Good number of people on, a lot of questions. So we'll get going. Just before I hand over to Damien, let me just remind everybody this is not financial advice. We don't know your individual circumstances, so this is just a general conversation. Please play nice in the chat room. No racial slurs. I do moderate the stream, but we do encourage also a lot of conversation, and that's part of the fun, I guess, for those following along. This is as of the 23rd of March 2021. If you're watching on replay, and if you want to ask a question tonight, use @WalkTheWorld to make sure you get my attention. There are just so many conversations going on in the chat, I may miss it without. And also, just to say that there is Super Chat enabled. You can ask a question via Super Chat, and that means it goes to the top of the queue. Or if you want to make a contribution to helping us to run the programs here, that's also available to you. So without any more waffling on from me, I'm going to bring Damien in. Damien, are you there?
Hi, Martin.
Eureka! It's worked. I always hold my breath at that point just to make sure. And so far, it always works.
So far, so good. Yes.
Yeah, great. Well, thanks very much for spending another Tuesday evening with us. And there are so many things to talk about. One of the things I want to sort of throw at you directly is the question that I've been kicking around myself, which is, do you think the Fed is selling what the market is buying, or do you think the market's buying what the Fed is selling at the moment? Because it looks to me a bit weird.
Yeah, look, I think there's an interesting disconnect between what's happening with the Fed and other central banks at the moment. So the RBA in particular has, so the Reserve Bank of Australia has implemented some yield control so they basically kept on buying the 10-year bonds to try and keep that end of the curve down. So actually, I should take one step back. So central banks really have what we call the short end of the curve, like the short-dated 2-year bonds, 3-year bonds. They've got those locked down in terms of prices. They're really not moving very much at all. The longer-term bonds are the ones that have been rising. And the Australian central banks come out with yield curve control. The Japanese central banks come out with yield curve control. The European has sort of got a version, not quite the same, but it's sort of a version of yield curve control. Whereas the Fed's basically said, well, rising interest rates at the long end is a sign that markets are starting to heal themselves, and so they haven't tried to step in. And I think there's certainly a lot of players in the market who would like to see the Fed come out and do that. And I think there's this part where markets are starting to try and push the Fed and saying, well, if you think yields are going to, if you're not going to implement yield control, then maybe that end of the curve should be higher, and so they're, I guess we're looking at part of those markets going to try and push the Fed into doing something, and we've seen that in the past. So we saw it, I think it was probably 2 Christmases ago, where the Fed was at the time was the other way around. They were raising rates, and markets were sort of saying, no, you've gone too far, and markets basically crashed until the Fed finally went, oh, okay, yeah, we have gone too far. And so there's a question now is, is that what markets are going to do, is keep pushing these yields until the point where the Fed finally does have to step in? I think as part of that, it is worth noting, though, the US market is quite different to other markets in terms of their mortgage market. So most of the mortgage there is priced off the 30-year bonds, whereas in most other countries, the terms are much shorter. And so I guess the Fed probably has a pretty close eye on the housing market in the US to make sure that, that's where we start to see the danger come through in terms of, and making sure that there's still lots of credit flowing to the US economy. So it's a long way of answering your question, but I think the answer is no. I don't think the market's buying what the Fed's selling, and I think the markets are going to try and push the Fed until that gets resolved, that part about the long end. And I do think as well, so it is worth noting for people that we're about to hit the low point in terms of prior comparisons. So March, maybe not March, I think more April, May, inflation in the US last year was very low, and we're expecting it to bounce back. I think we showed a chart last time of those. If you have a low base, then then you get a high inflation read. And so, and the Fed knows that's coming. They've talked about it coming, but it'll be interesting to see what the market's doing when you get, say, look. We're expecting it at least to be in the 3%, and it could be as much as 4% in terms of the headline inflation. And it will be interesting to see what the market does when that comes out, whether there's a bit more sort of inflation panic.
Yeah, well, I have this view that the market was quite disappointed. I think they were expecting Powell to give more direction with regard to particularly bonds, and they expected him to go and do, the old switcheroo between the long term and the short term, or at least make some comment about controlling the long end. And as you say, the fact that go on.
Even just a future threat, saying,
yeah.
If they keep rising, we will do something.
Yeah, but no, completely silent, right? And my view is that actually create a little bit of sharp intake of breath. And of course, we saw the long-term yield rates go up quite a bit after that non-announcement, right? After the press conference. Yes. Now, there's also something else that's linked to this, and that's the SLR, right? The supplemental liquidity ratio, right? Which I think has something to do with what's going on. And just to remind everybody, the SLR was essentially adjusted. This is the amount of liquidity that the banks have to hold. It was actually dropped by a couple of points a year ago when COVID hit, which basically said if you buy treasuries banks, you don't need to hold any liquidity against them, right? So basically it allowed them to sell all their treasuries to the banks, right? But now they've announced at the end of this month that's going to be unwound. So therefore you now have an extra requirement, right? Now, the interesting question is, what will banks do, right? Particularly the GSIBs. What will they do? Will they dial back on their lending? Will they buy more treasury bonds to be able to sort of lift it back to where they need? That, for me, is the bit of the puzzle that people haven't got their head around, and I think it's quite important.
Yeah, and I think it varies between banks. So, the analysis I've seen, highlights which of the banks, and I haven't got the analysis with me in front, but there's, I guess it ranges between banks that are actually relatively well covered, and banks that will need to get out and buy some more in terms of covering that ratio. I think that the net effect of it, from the analysis I'd seen, which seemed reasonable, was suggesting that at most it'll be a short period of indigestion, and that if there were any concerns, the Fed could easily change it, but it probably wasn't a dramatic effect. But you're right in terms of some of this could easily be front running as well of in terms of that. If you know what banks need to do in terms of the amount of purchases they'll need to make, and trying to get in front of those.
And we know that there was about 80 billion of bonds sold ahead, right?
Yeah, and that's right. And the other thing, the other big factor that's making a difference in the US Treasury market as well is there's a facility that the Treasury uses, and it had actually in terms of where it deposits money once it's raised. So the Treasury needs to go out and sell the bonds, and then once they've sold them, then they start spending the money within the government. And that facility was actually very high, and so they've been running that down over the last little while. So they haven't actually need to issue as much bonds as what they've been spending, and that's sort of coming to a finish over the next probably 3 or 4 months as well. I think there'll be a bit more. So basically, what that'll mean is they'll have to start issuing more bonds in order to cover the spending that they're doing, which may just end up meaning that the central bank has to buy it. Quite possibly it does if there's too much concerns. But as you said, there's a number of things happening around that's giving the market participants concern over what's happening, and the fact that you're not getting that direct guidance from the Fed is obviously upsetting a few people.
And I'll just throw one more in, and that's this particular picture, right? This is actually what's happened to the dollar index, right? So basically, we had a lot of people basically on the short side. And now suddenly they've actually switched to the long side, right? And you can see it beginning to move up. So there's a dollar question here too. And I'm not quite sure precisely which way it's going to go, but there are some people suggesting that maybe we're going to see the dollar on the move.
Yeah, I think we're certainly of the medium-term view that the dollar is headed, the US dollar, that is, sorry, is headed higher. Insofar as the US is doing the most on the fiscal side, their interest rates are obviously, especially at the long end, are rising more than what we're seeing in other countries, and so there is more likely, and we're expecting better growth come out of the US, and all of those in the medium term, we think is better for the is going to be better for the US dollar.
Absolutely. Well, it'll be very interesting to see, and that could put some interesting tension between the US and China, of course, as well. Just to add a little bit more spice to the.
Well, yeah, and certainly, so they've just come out of that Alaskan meeting, and for anyone who's sort of not paying up to the minute, basically it wasn't a friendly meeting. It was in
the shouting match.
Yeah, and especially given it was China's first, I guess, chance to sort of speak one-on-one to more directly with the Biden team. I guess there was a chance, or certainly the expectation was that they might try and sort of repair some of the damage that was done during the Trump administration, but it was pretty clear they weren't going to. And I mean, it's quite possible anyway that Trump. Quite possible they're doing that because they sort of were back channeled enough to know that the Biden one wasn't going to back down on these things. But it's clearly showing that the tensions are not easing at all.
No, that's exactly right. And I think we're going to see some more interesting fireworks there, not least because of the Quad, right? The meeting with essentially the US and Australia and a couple of others, India, for example, and Japan, basically saying we are going to club together and actually coordinate our strategies to try and actually buttress against China. So that's another indicator that, the contentions which were always there are going to continue to build. And that could spill over into trade. It could spill over into political negotiations. But also, I'm still expecting at some point to see something on water, as it were, up in the straits, right? When there's going to be some sort of test, there's going to be some sort of, let's see how far we can push it, sort of thing. So, I think this is going to be an area of considerable tension, not least, of course, with Taiwan in the background and Hong Kong in the background. Yeah,
definitely. And so I think. From our perspective, the one of the key things we were watching from the to see from Biden was that he'd obviously been the vice president under the Obama administration, which had basically pretty much allowed China to flout some of the things they said they were going to do, with the view that it was better to be closer to China and to help convince them to keep going through and the reforms and opening up. Trump obviously rode to power on taking the opposite view of that, and it was there was potential that Biden would tone things down as well, I guess from that side, but it's pretty clear that he's treating this as something that needs to still be that actually needs to be engaged with, and it's not, there's not a question of going back to how things used to be, which we think is a good thing for democracy and the rights of people, but it's obviously there's some tensions that will happen from that, and what that means for companies involved. We've been steering clear ourselves of Hong Kong for some time. There's certainly a lot of companies within China that look like they're making lots of money. We've got concerns over some of the accounting that goes on within, but there's also sort of those bigger concerns that I think a lot of the companies there will be allowed to be very successful within China, but there's dangers of stepping outside of China in that they just won't have access to the same markets, and those markets will be restricted over time.
Well, the fact is that the China market is a unique market, and trying to find replacement export markets relative to China is going to be tough. Even if you think about India and other places.
Yeah, in some things, and education's obviously the biggest one, where it's it's just impossible to find another country that's big enough and rich enough to want to send so many students across. Tourism's another. But in my view, things like iron ore, barley. We've actually seen barley prices are, it's been banned from China, but barley prices are actually higher now than what they were before. Commodity, and in my view, that's because these are commodities that there's a relatively fixed supply around the world, and if China's not buying from Australia, chances are that means they're buying from Brazil or South Africa or somewhere else, which means then instead of the Middle East buying barley from Australia, from Brazil, now China buys it. Now Australian barley goes to the Middle East, and it's all
musical chairs, right?
Yeah, exactly. So, and that's because they are commodity items, whereas education is not a commodity item. We'd like to hope it's not a commodity item. But yeah, that's probably something for another time.
Well, I was going to say, my wife, works in the education sector, would probably disagree with that. She thinks it's being more like commoditized to bilio. Exactly right, which is not good for anybody. But we won't touch on that now. That's a conversation another day. Now, let me just pick up a couple of chats. Motorhead, thank you very much for that. Yes, as you say, don't worry about toilet paper when the currency is worthless. Well, that's always a thought. Digital currency, of course, could be significantly to disadvantage for that particular purpose, right? Yes. But there was another question which I think is worth just focusing in on. If I can just pick that up, there we go. And that is, how will yield curve control affect gold? I think that's worth just exploring a bit, Damien, because it seems to me that if yield curve control is essentially trying to keep rates down, that's partly to do with not allowing inflation to sort of take up, right? And then the deflationary or static environment, the value of gold probably goes down rather than up.
I think so, and I guess we had a lot of gold mid last year, and we've just been progressively selling it, for the last 6 months. So we're sort of down to not very much gold, on the back of rising interest rates, and the Fed allowing them to keep going, is not a particularly good outlook for gold. I think gold's got its position in the portfolio as a bit of an insurance on particular events. It seems at the moment that most of those events that you would need insurance for aren't actually likely events over the next little while. And so, I think, absent big sort of macro changes, gold's probably going to do it pretty tough.
Yeah, it probably goes with other precious metals too. My colleague John Adams is a very strong supporter of silver and arguing that it's highly undervalued and will bounce to astonishing levels at some point. And I keep saying to him, maybe not. We'll see.
Yeah. It's not a metal we're doing. I've actually got a few posts which I'm working on at the moment. I was trying to do a bigger one, and I ended up putting it in a series of smaller ones now, just looking at commodity prices over the long term. And this, because it's this idea that, and we've seen in a few, some of the Wall Street banks are sort of writing a lot about, we're in this commodity super cycle, and inflation's about to boom, and so you've got to jump on commodities because otherwise you'll be left behind. And the issue is the prices are already in a super cycle. So, and if you look back at inflation adjust, the prices are pretty steady for things like iron ore or copper over the longer term, and they're just way, way, way above their longer term where you'd expect them to be over the longer term. And it's not as if iron ore in particular is a very common and copper as well. They're very common minerals. They're available in lots of places. There's lots of big mines that haven't been developed that could be brought on. It's really it's an issue about timing issues, about saying, well, there's a short-term supply-demand shortage, which means prices can spike very high, but that's very different to saying they're going up to this permanently high plateau, and that's where they're going to stay for a long time, because in a lot of cases, all it takes is one big new mine to come on, and that'll smash. That'll bring on enough supply to more than right the supply-demand issues.
Yes, and touching on inflation briefly, and there's a couple of questions on inflation. I might just put this one up. Rise in the number of countries now due to inflation, as they show CPI as a sham figure, right? So there's a question about, is inflation being calculated correctly. And in fact, I was reading something the other day that said, well, if you actually calculate inflation the way that it was done in the early 2000s and look at the Fed, for example, they wouldn't have cut rates in 2005 and 6. That means they wouldn't have created the global financial crisis, because that was actually created by the rates going up in response to inflation, right? And that means that we wouldn't have had the global financial crisis, and that also means we wouldn't have had all the pain over the last decade. Now, interesting debate. I mean, the CPI, of course, is tweaked dramatically from where it used to be. Housing is not in. We have, asset-adjusted measures on all sorts of things as, the quality of goods change. And actually, around the world, CPI is really, really low at the moment. So I don't know what your perspective is on that. I guess we have to deal with what the measure is, but it does beg an interesting question.
Yeah, look, I think for my part, one of the key issues we noticed with that CPI is that, and I might have spoken about that last time I was on here, is that inflation in things you need is quite high. So, I was doing the comparison between, vegetables. The inflation in fruit and vegetables was high. In ice cream, you had deflation. If you look, health services, you got a lot of inflation within that health services market. Education, a lot of inflation within those. Deflation in flat screen TVs and white goods. And so it's a part of it is that whole issue about trying to it's the infrequent purchases that people make, and which is a problem insofar as often those infrequent purchases are the ones you can delay. You get the ones you can say, well, I bought a new flat screen TV 4 years ago. I can wait another year or another 2 years before I buy one. Whereas if prices are higher and you want them to come down, or you're doing a bit tough. Whereas if you got to buy your fruit and vegetables to make it through. And so I think that's where people get the feeling that inflation is understated because of all these ones that keep going up. And in Australia as well, the electricity prices obviously have been rising quite dramatically. We've got some of the highest electricity prices in the world now, from having some of the lowest ones in the world. And so I think what people see on their day-to-day purchases, the inflation is certainly higher than if you take into account some of these infrequent ones. And you're, the question, are we bringing that in the right, have we got the right timing on those? And the fact that the latest phone I've got does more than the last phone I did, is that actually important? Because in the end, it makes a phone call. That's the key use of it. And then the whole part about whether I can, Snapchat people faster or whatever it is that really an improvement that then should go into saying that this phone is more productive than it used to be? Whereas possibly, improving access to Snapchat means it's less productive for society, if you know what I mean.
Well, indeed. And the other thing about the inflation is, right, you can have monetary inflation, which basically is, liquidity being thrown in, right? That doesn't necessarily translate into the real economy, and therefore perhaps the real inflationary measures don't show it. Or you can have inflation that effectively stems from wages increase. And we've had no real growth in wages over the last, probably decade in Australia. And of course, Lowe the other day said he doesn't expect wages growth to rise anytime soon, because the unemployment rate has to come down below 4% before that happens. And that's not going to happen for at least 2 or 3 years. So we are going to be in a situation of wages stagnation at best. So that's another deflationary or stagflationary indicator rather than inflationary indicator.
Yeah, so I mean, this discussion that's going through central banks at the moment, where they're talking about saying, well, maybe we shouldn't really be targeting CPI, maybe we should be targeting wages. And if we can't get wage inflation, then that's that should be the better measure, because that's something that sort of gets entrenched. If wages, it's called that cost push, where wages start going up, and therefore companies put their prices up, and therefore all the workers sort of keep demanding higher and higher wage rises, whereas that seems to be pretty much well squashed at the moment. And there's also the whole work from home and just the globalization that we've seen over the last few years means that now for a lot of people, if wages are too high in Australia, well, there's people in Karachi or Bangalore or somewhere like that can do the job, and so that's sort of going to put a lid on wages generally as well in terms of I think that's made things worse. The whole work from home, which is good for people's flexibility and everything, but in terms of is work from home good for wage growth? I think the answers will be a resounding no. That it means that we've actually just opened yourselves up to global competition now on wages.
And I'll give you another factor to impact wages negatively as well. ScoMo the other week said we need to actually get migration back going, right? And in fact, we might prioritise migration over bringing Aussies back who are trapped overseas, right? Now, of course, if you think about it, if you increase migration, that puts further downward pressure on wages again. So another reason why wages may not go up at all.
Yeah, absolutely. Actually, and I had in my last podcast, I had Ross Garneau was on talking about his book. So he's got a book out called Reset.
Yes.
And that's basically what he spends most of his time talking about, is saying, well, we know that, yes, we had this mega long boom, but actually the last, as we've spoken in the past, from 2012 to 2020, the boom was actually only at the headline level, not at the per person level. And that if you try and go back to doing everything we used to do, it's going to put us right back there. And actually, chances are we couldn't get back to that anyway, even if we wanted to. And so, he's very much of that same view, which I concur with, and obviously you do as well, is that trying to get back to what we used to had, not only is it a bad idea, we probably won't be able to make it anyway, and it's going to make things a lot worse for everyone.
Yeah, well, back to the future is not the way to do this. We need to be looking forward rather than back, right? And sort of reinventing ourselves for the future. And I think the book's very good. I mean, I had a chance to explore it, and some of the ideas that he comes up with in terms of how to think about it differently, I think are really well communicated. The trouble is, of course, that so often it falls on deaf ears in political sphere, because you come into election cycles and you come into ideology and doctrines and all those things, and unfortunately in the process the economy gets murdered.
Yeah, absolutely. And so there's been an exciting day in terms of politics today as well. For I think Morrison's put his foot in it once more, and questions. So certainly lots of questions about their performance. I think that on the other side, Labor went to the last election with a lot of big plans for reform and lost.
Failed, yes.
And failed.
Yes.
And it would seem that Albanese's goal is to make as small as target as possible, and to basically, just, I think their point of contention is that they're not the Liberal Party, I think, is basically what they're offering, and little else. And so, do I expect big changes if we had a change of government in a year's time? I don't think so. Do I expect a bold new plan from the current government? No, they haven't had one so far. So it's hard to see them coming up with something quite, anything. They've been very, very, very. It's all been about the announcements, and rather than about the trying to make structural change. And reactive, I guess. So I think there are some. Obviously, the speed and that they reacted to the pandemic was very good in terms of putting out lots of money. I don't think it was well targeted, but it certainly wasn't anything like a new regime to sort of usher us into this new period of growth. And as you said, that from that headline, a lot of it's all about looking backwards and saying, well, can we just keep doing what we used to do, and hopefully that'll work again.
Yeah, and I've highlighted a few times in some of my other shows the issue of things like preparing for the inevitable carbon situation and the warming situation. It's interesting, a lot of the big global investors put out a report today saying they actually expect companies to step up and have much more coherent plans about adjusting their strategies so that by 2050 or whatever it is, the target to be net zero. Investors around the world are actually driving some of the thinking here now.
Yeah, absolutely. So we've for years had the option for people to be able to tick that they don't want to invest in anything that has anything to do with carbon. and a lot of our, that's, I think, the most, certainly among millennials, that's the most common one we have, in terms of people choosing to exclude any of those stocks. We find within the companies that we look at, it's a big issue, and they're certainly looking at it with, they're not looking at it from a political angle. Let's put it that way. They're looking at it from a practical angle of saying, yes, something will be done, something will need to happen. There will need to be carbon prices. We need to, and companies have been doing it for 15, 20 years. We need to assume there will be a carbon tax, and go about our business accordingly, regardless of what the politics of the day might be suggesting.
Absolutely. There's an interesting question from Vanessa. I'm not sure whether you've got a view on this, Damien. Where can I find out more information on the banking bonds, the majority of foreigners who own them? The distribution of information about bond buying and selling, it's tough to find, isn't it?
Yeah. Look, I think most of there's a certain amount of information you get from places like Bloomberg, S&P, Moody's will have a bit of information on that. I'm not sure how deep you're looking for. Yeah.
And there's a bit in the ABS as well that actually gives a bit of a breakdown of the funding, but at an aggregate level, right? Foreign versus international versus local. But it's very, very high level, and it's very hard because they do have the financial sector category split out within the ABS data. But no, it's pretty fuzzy, and if you try to actually say which countries are investing, what currencies, it starts to get very, very fragmented at that stage.
Absolutely, and I'd probably say especially for anyone who isn't used to wandering through ABS databases, that the RBA has a lot of the high-level data as well in spreadsheets that you can go and download. But obviously not as much detail.
Yes, the RBA sort of sanitizes some of the ABS stuff and then says, well, if it's not right, it's the ABS's problem. So that's another story.
But then they'll have APRA stats as well and bring them together. I mean, APRA is the other one, does have a lot of detail within those, but it's potentially,
Well, my models, I pull information from ABS, APRA, pretty much all the other sources too. RBA is a good one. I reckon there are about 7 or 8 different key sources, plus the private sector, the Moody's and the Standards and Poor's data sets and those sorts of things. But you have to be able to pull that information together and then actually iron it out, because you've got different bases and all sorts of things, right? So it's none of it's straightforward. I have a theory that it's deliberate rather than actually being just chaos.
Yeah, and look, if you look at things like CPI as well, the measures from different countries are all quite different in terms of what's called core CPI or underlying or whatever. Different countries have different measures, so as soon as you start doing cross-country comparisons, it all gets it's very difficult.
Indeed, yes. Well, cross comparisons between countries. I'll give you another interesting example of that. I was looking today at some research that's just been done in the last year in the UK. An extra 2 million people have started buying and selling shares and stocks because of the lockdown and because they had time to do it, right? And 10% of those have now decided that they're actually going to become day traders and give up their main job to try and actually make money day trading, right? Now, if you sort of read that through, that would be like, half the number. So 100,000 people in Australia now day trading that weren't day trading before, and 1 million who are now trading. And, some of them have, attracted by GameStop and all those sorts of things, right? Think it's so easy. Of course it's so easy, isn't it, Damien?
Oh, absolutely. Same thing happened in 99 as well. So in the tech boom, a lot of people quit their job and day traded, and I think it's until the whole thing finished, and then lost a lot of money. So I think there's the key thing I'd highlight to anyone who feels as if that's that they'd like to be a day trader, and that'd be how they're going to spend the rest of their the rest of their work life, is that there's a number of strategies out there that are effectively the same as selling insurance. But you just don't know it. And so I'll use an example is, I could decide that I'm going to be a home insurer tomorrow, and I go out and I get $100 from everyone a month, and I find 1,000 people, and now I'm getting $100,000 a month. And I'm like, okay, great, isn't that great? All this money coming in, and then the next thing you know, there's a flood and half the town gets washed away, and I realise that I'm now on the hook for all that money, or there's a fire and somebody's house burns down, and I just haven't collected enough premiums. And so, and there are places in the market that are like that in terms of you're being supplied you're out there supplying liquidity to other people who are basically saying, I will give up, 0.5% of that trade every single day because I don't want to lose, 50% or 100%, once a year when something happens. And for the people who are doing that trade, it feels really good. They're like, oh, look, I made this little bit of money today, and I made a little bit of money the next day, and I made a little bit of money the next day, and then all of a sudden there's a big loss, and they're all wiped out. And so, I guess what I'd keep in mind is if you are doing day trading and you do have a strategy, make sure you understand why you're making the money. So not that because it's not that people want to give you this free money. It's whether you're actually taking the opposite side of one of these trades and you just don't realize it.
Right, and that's 2 points to make. The first is for every trade, there's a winner and a loser, right? Right. So you want to be on the winning side more than the losing side. It's actually very hard to do. There was a famous book written some years ago called A Random Walk Down Wall Street, right, which basically tried to analyze whether it was feasibly possible to win more often than lose. And basically their conclusion was it's random.
Yeah, I think there's and look, there's a lot of debate obviously in the market about what's how much is possible and how much isn't possible. I think what I tend to think is, and we'll show up a graph because I think we're going to talk relative value later on. Is that if I can find an intersection of quality and value that suits me, in terms of saying I want to find if I find high quality stocks, then I'm prepared to pay a little bit more for them. And if I'm looking at very, very cheap stocks that are only average quality, then if they go up in price, then I want to be selling them. And so to getting that trade-off right, and that tends to work in the longer term. And what it tends to do, though, is it tends to outperform on the downside. And if you can try and stick with the market on the way up, then that's great. So, and you can underperform a little bit when markets have these blow-off tops. But yeah.
And the other perspective, of course, is timing, right? The idea of investing is you don't sort of do it just for a day or two or three, right? This is a strategic medium to long-term thing that you're doing. And within that, there will be ups and there will be downs. But you are also, of course, benefiting from inflationary forces if they actually take things up, and compounding of interest and those sorts of things as well, which is all part of the growth over time, right? So you've got to give it time as well.
Yeah, that's right. And there's actually what we find very interesting, and I've found very interesting right throughout my career is when you just people who have not a lot of money and come to you and say, oh look, I want you to invest this money and I want to make a whole bunch and I'm going to retire on these massive gains you're going to get. Whereas people who already have lots of money are basically, look, I want to invest and get a small return and don't lose it. They're there to preserve their wealth, as opposed to people who look upon the stock market as a chance to instant riches. For the vast majority of people, the stock market is there to maintain your wealth and to grow it, slowly. It's very, very, very few people who make the sort of lottery-like returns you might have seen in GameStop, and actually even the returns from a lot of the investors you saw in GameStop. Yes, they made them, but then they gave them all back because they didn't sell when the market rose.
Absolutely. Well, let me just do a couple of things. So, Jason, just many appreciative comments just to say thank you for supporting us. Really appreciate that. It really does help to just cover the cost of what we do. And I also just wanted to mention this particular post. Zach mentioned my show on debanking. I interviewed somebody the other day who was actually debanked by one of the major banks in Australia for not doing anything wrong, but his business basically is suffering as a result. Just shows you the unequal power between banks and small businesses in particular. We might touch on small businesses a bit later. But the other thing I wanted to move the conversation onto was this question of value investing versus speculating and all those sorts of things. And I know you've got a few slides to go into, because I asked you specifically to try and actually get into some of this in a bit more detail, because I think it's really important. People need to understand there's quite a big difference between the two.
First of all, there's always something that's relatively cheap, I guess is one thing. Is that regardless of how expensive or cheap the market is, there's always part of the market that's more expensive than the other part of the market. And so there's always this idea of relative value. And so when I tend to look, I tend to look at things in two different ways. One is from an asset allocation perspective of how much should I have in Aussie shares, in international shares, in bonds or cash. And that's sort of that's making some decisions about which of the asset classes are the most expensive or the cheapest. A separate decision is within the actual portfolios for, say, international stocks, which I've got up on here at the moment. Where do all the stocks sit on the x-axis? I've got from cheap is in the very left-hand corner to expensive in the right-hand corner, and then from good quality to poor quality as you rise up. And the idea is I'm trying to buy stuff that sort of sits in that green zone and hold things that sort of sit in the grey, and then once they get too far outside that, it's time to sell. Now, it looks a lot easier on something like this, where I've shown you where Apple is. So Apple's like a bit getting close to expensive, but it's actually really good quality, and so there's reasons for why you might want to hold it. I've also got a few other little stars on there sort of showing, the future. If I only looked at forecasts, where would it be? If I made some adjustments for coronavirus, it actually ends up a little bit higher on the, it's a little bit more expensive, but a little bit better quality. Things like that where nothing's got only one axis. I've simplified this to two axes, but is it cheap on earnings, or is it cheap on cash flow? Is it cheap on book value? There's a whole bunch of different measures we can try and look at. So that's the framework I'm looking at. And then I just wanted to highlight that the market itself, in terms of earnings are actually growing really strongly at the moment. So this blue line is what we call is the forward earnings line. So it's for the US market, just because it's a nice easy one to show a longer period of time, and it's actually a rolling period where every day it just gets a little bit more of the next year and a little bit less of the previous year. And so it's always looking this constant sort of forward, 12-month forward. And you can see that this blue line's rising really, really sharply at the moment, and it's actually exceeded the peak that it reached in 2019. And so I guess the message is that companies did a lot of cost cutting throughout coronavirus, and now earnings, the revenues are coming back, or they've just learnt to deal with the shutdowns and other factors. And so earnings are actually doing really well at the moment. There are potential things that could upset that, but it's worth noting that looking back at the coronavirus period and deciding that stocks are expensive or cheap is not the way you should be doing it. You should be more looking forward to see what type of earnings are coming sort of down the path. Okay, so that's the sort of the earnings side is looking very strong. Then there's a question about how much you want to pay for those earnings. So and this is the same chart I showed last time, where I've broken out everything in the grey area is basically the middle 50% of stocks. The blue line is the median stock, and it's looking at what the price you'd pay for it versus its earnings. And to add one extra complexity, I've actually stepped another year forward. So because of all the distortions of the coronavirus, I'm actually looking 2 years forward, just so that I can actually get a better view about how we sort of sit relative to the time. And so last time I was on, I spoke about saying, well, look, we can see the top of this is really expensive. So the top 10% is sort of sitting up at sort of 45 times earnings, which was only ever similar to the last time I was there was in the tech boom and the tech crash. And at the 25th percentile, again, sort of 25 times earnings or greater is, last time we saw that was back in the tech boom, and that ended badly as well. But if you look at the other end of the market, you could see that the cheapest 25th percentile stocks was actually only slightly above average. Since then, it has got more expensive. We've seen this last little spike. I think last time we spoke, we were closer to the previous little bottom there, and so it's actually put on a spike. And this has been what you call the value rotation. So people have been selling the growth stocks and buying value stocks. And so while they're not expensive, they're certainly more expensive than last time we spoke. And if I go one step further and say, what about the cheapest 10% of stocks? Well, again, there's still some cheapness within that, I guess is where I'm getting to. There are still stocks out there that look, if you look relative to how they've traded over time, if you look over the last 20 years, you're not buying them at 20-year highs. And having said that, though, there's a lot of stocks in there that have problems, and so it's about the matter of finding the right stocks and the issues. So the types of stocks you see in here, tobacco stocks are pretty well dispersed throughout them. Real estate trusts, particularly retail real estate trusts, you'll see within those. There's insurers within those. European banks, in particular, you find within this group. So you're not buying pristine companies with great growth outlooks. You do need to, you're rummaging through the bargain bin. You do need to be a little bit discerning about what you're going to pull out and what you're actually going to buy, because there are a lot of stocks in there that look really cheap, but their earnings are going to halve over the next few years, and the share price is going to halve, and they'll still look cheap. And so, it is. There are pockets of the market that are still cheap, I guess is the overall message, but you do need to be quite discerning about what's coming into it. It's not just sort of a blind buying of whatever's there. Is that? And then, and the final one I just wanted to highlight as well is same as the last time. Is I'm just showing you a chart of what happened following the tech boom. And so we sort of had a 6-month period where the NASDAQ, which was with all the high-priced tech stocks, fell 30-40%. And in the meantime, the MSCI World Value Index actually rose over that period. So the value stocks were doing, we're actually going up while the start of the tech boom, the start of the tech crash happened. Post 2000 was actually into recession, and all stocks fell. But there was a 6-month period where stocks weren't in where markets weren't in recession, and you saw that value trade really played out well. And that's what we've seen over the last few months. The only thing is we're seeing it in fast forward. It took 6 months for that to happen in 2000. It seems to be happening a hell of a lot faster at the moment. So the value trade we think is still there, but we're starting to look for the next trade, as we speak.
Yeah, very interesting, and I think it shows that it's a bit like property, right? You can't say the property is a single market, right? Just as you can't say the stock market is not a single market, right? There's a complexity in terms of the types of shares and stocks that are there, country dynamics, sectorial dynamics, all of those things. To give you an example, the NASDAQ is down, about 6 to 8% from its highs, right? That's because the bond rates have gone up, and that means that now people are actually forward valuing the future value of those tech stocks down a bit, because effectively the future rate is going to be higher. So there's a bit of a rotation back from the tech stocks to some of the more sort of stable stocks that have been out of fun, out of favor, right?
Out of favor, yeah. And the economic growth is looking better for that. So a lot of these stocks are stocks, say cyclical stocks that go when GDP growth is good, their growth is very, very good. When GDP growth is poor, their growth is very, very poor. And so they sort of spent the last year or so very much unloved, and now you're starting to see that bounce. As people start to upgrade their views of the economy, and quite frankly, the amount of stimulus we're seeing coming out of the Biden government is forcing you to say that there's some of these sectors that on their own volition may not have done well, but they're going to be driven by government stimulus to get the growth.
And there's a green package, what, 3 trillion coming as well. So yet more of it.
Yeah, that's right. So, I think there's there's the adage about fighting the last war, and that investors who were expecting that Biden would come out with Obama type policies and would try to would be content to have them whittled away by the Republican Party to lower levels. I've been surprised, and I think we're expecting this to continue in terms of that he's got another chance later on in the year to do another budget resolution, and we fully expect that he'll try and put through as much as he can, and has learned the lesson that from the financial crisis that they didn't do enough early enough, and that meant the economic growth was never as strong coming out of the as what they expected, and they started losing power right throughout that period. So and then I think that's the lesson they've learned is basically stick to your principles and try and push through as much stimulus as you can while you have 2 houses of parliament, which they do for the moment. Expires in 2022. There's another vote. So who knows what will happen at that point? But I think they're certainly trying to get as much as they can while they've got both houses.
And it's also worth underscoring that if you think of it from an RBA perspective, right, the RBA is going to be trying to doing stuff locally, but when you've got that £1,000 gorilla over in the US doing all of this stimulus, it's almost irrespective of what you are going to do locally or want to do locally, it's down to what the Fed does.
Absolutely. At the long end of the bond curve, that's true. I think at the short end of the bond curve, the RBA is fine. It can do whatever it wants, and it'll force things to happen here. But world economic, we're a small open economy, and so we rely on world economic growth. There's nothing you can really do about that as an RBA governor, and even as government, there's we've got what we have. You can try and become a closed economy again, but there's no way we're going back to that. And we're obviously a big commodity exporter, and so we want everyone's markets to be open. And so Australia is at the mercy of international markets, very much so.
Absolutely. Now I just want to pick up Vanessa asked this question, which I think is quite interesting. I've been reading on BIS and OTC derivatives and wondering what the collateral for the Aussie banking bonds is. Is it government bonds or Aussie mortgages? So I'll give you my take, and then Damien might want to come in over the top of me, right? So the bottom line is this: the Aussie banking bonds, particularly those issued by the large banks in Australia, are intrinsically regarded internationally as underwritten by the Aussie government. So there is basically an implicit understanding that they will never fail because the banks know that the government will never let them fail. Now, that's the sort of the top level meta view. If you come down a bit, then if you think about the structure of the banking system in Australia, about 65 to 70% of the assets of banks are actually mortgages. So you could also argue that a lot of the mortgages are actually predominantly supporting the banking system. And of course, some of those bonds are specifically securitized mortgage pools, although actually more securitized pools are being sold in Australia rather than internationally, until certainly quite recently. So that's the second point. The third point is that smaller organisations are finding it quite a lot harder to be able to use bonds as a funding mechanism. And that's one of the reasons why the Reserve Bank, as part of its program of support for the banking system, as well as the TFF, which is still running at the moment, giving very cheap funding to the banks instead of having to use bonds, they specifically developed some programs to support the small end of the banking sector because they were the ones being diminished by their inability to be able to raise funds through bonds. So that's my take. Damien, anything to add?
Yeah, so I think the collateral, the key part with the collateral is it does vary by line. So some of the bonds are bonds that have been issued by the banks with their own assets as collateral, the banking assets, and they're the ones which Martin's saying, they're not officially backed by the Australian government, but the understanding is that the government will come to their rescue if something goes wrong. that they're systematically, the four majors are so systematically important that the Australian government would not allow the banks would not allow those to default. That is the understanding. But again, that the question, if anything comes for those, then the question will need to arise. And I think as well, typically what happens is local investors are generally looked at first, and overseas investors are a distant second. So where we've seen banking crises in the past, often what's happened is the defaults have been on international investors, and local investors tend not to be defaulted on only in more extreme circumstances. And then other banking lines, so as Martin said, are actually collateralized back to the pool of assets. So it might be a pool of mortgages have been put together, and that's what the collateral is. So I guess where you're leading to is are there issues for the Australian banking system? And I think my answer is not at the moment or in the immediate future. I think what has happened is that the RBA, as Martin said, is providing this thing called the Term Funding Facility, often seen it called the TFF, which basically means they'll lend bucket loads of money to banks as long as the banks push it out to mortgage holders. And that means that the banks don't need to worry as much about funding. There's very high levels of savings at the moment, and so that means the banks don't have to worry about funding. And property prices have been running hot, which means if the banks do, if they start finding customers are having problems now that they have to start paying their interest and everything, which I think is all at the end of this month, then the chances are they will be able to sell the property and not take too much of a loss, if any. And so I'm not saying the Aussie banks are forever and forevermore a perfect asset, and they have got other issues, but in the short term, we're living in this market where, and potentially the medium term, we're living in a market that's dominated by central banks and governments. And one of the ways they want to use to get the money out is the banks. And so, as long as you believe that they're going to keep doing whatever it takes to keep things ticking over, then the banks are unlikely to default.
Well, my view is that banks are a protected species, and a lot of the programs that have been announced over the last year plus really are about bank keeper at the end of the day, right? So they know they know that financial stability and confidence in the banking system is a number one, number two, number three objective, almost at the cost of everything else.
I mean, the RBA is lending to banks at a cheaper rate than what the state governments can borrow at.
Yep.
Like it's a remarkable situation, and I'm sure I talk about this all the time. Go to Europe, and the central bank over there is paying banks 1% to lend money out. So there's a negative interest rate. So the bank goes and makes a loan to you. You pay $100 worth of interest. The central bank then goes, "Oh, you managed to get Vanessa to pay $100 worth of interest. I'll give you $200 to help cover the cost of the loan." And that's just to keep the banking profitability, so the banks don't go bust. And so, as Martin said, protected species very much. It's not necessarily a great thing for equity holders. So over that time period in Europe, bank share prices have actually fallen 50%. But in terms of worrying about the banks going bust, that's a much less of a worry.
Yeah, no, I think that's right. And things like the concern of bail-in and those sorts of things, I think you can sort of dial that back simply because of what's going on and the fact that the Reserve Bank has definitely proved its ability to just go on throwing money at the banks forever, right? Remember, it's our money. It's our money they're throwing at the banks.
Yeah, but as well, keep in mind there is that strong part for there's so many shareholders of Aussie banks that if there are problems, you would think the government will try and minimise the pain for shareholders. But it's also that that point I was saying before. If you're an investor in a Russian bank or a Spanish bank or a bank in Crete that starts having problems, then as an Australian citizen, you probably have to worry about whether you'll get all your money back. But because they're much more likely to prioritise locals over foreigners, and the same will be most likely true if anything happens in Australia.
We saw that with the global financial crisis up in Europe. So there were a lot of people in the UK who actually were invested in banks in Iceland, right? And basically the Icelandic said, "Well, it's tough."
Yeah, and Cyprus did the same thing with a lot of Russian investors. So yeah.
Now, okay, this is one from Cookie Boy, which I think you'll like as a question, Damien. Okay, does Dr. Evil Klassen see any potential triggers for a stock market crash? Discuss.
Yeah, I always see triggers for a stock market crash. I'm not particularly worried about any of them right now. There's always things that can go wrong. We're sitting on a huge pile of leverage, so there's lots of debt in households in Australia, not as much overseas. There's lots of debt in corporates. Governments are filling up with as much debt as they can. If the US dollar starts to rise significantly, we spoke about that earlier. There's potential for some emerging market issues. We already saw Turkey's struggling with inflation and keeps firing at central banks and having central bankers, and having issues. There is potential. That's probably the most likely thing I'd see that can go wrong, because it's not something that's as easily fixable by throwing more money at it. So I guess we look upon banking crisis and corporate crisis as the central banks can step in again and say, no, we're going to support that market. And we had the Fed, talking about supporting some of the high yield markets, last year, and so which sort of really calmed that part down. So I think if central banks and governments can fix the problem, they will. We saw right around the world people put freezes on people having to pay their mortgages and saying, you don't have to pay your mortgage. So that whole attitude now has sort of thrown moral hazard out the window and has said it's all about keeping things going until we're through this pandemic. An emerging market crisis is probably the most is the part where a big blow up in a say a range of countries like the Asian crisis. You're unlikely to see the US Fed or other ones say, well, let's go and throw billions and billions of dollars at propping up these other markets that aren't actually part of it. So so that's probably the biggest danger. There's always lots of other little dangers that we sit and worry about, but the worry level now versus at other periods is not particularly high.
So you didn't mention wave 3 of the pandemic, right, which is sweeping parts of Europe.
Yeah. Look, the vaccine data I'm seeing is just far and above what you could have hoped for. Like if you had to come back, a year ago and said, we're going to have 6 or 7 vaccines with 65 to 70% plus efficacy rates, and so even if there was a bit of a scare about the AstraZeneca, which appears not to be an issue, but even if that had been an issue, there's still 4 or 5 other vaccines out there that are exceptional. So to be in this situation, I think is you can't underrate how positive it is as an outcome. And so in terms of the third wave, look, I think there's I think governments have certainly seen the light at the end of the tunnel in terms of the vaccines and actually getting people vaccinated and then starting to open up. And with the data that's coming out of Israel is very, very good, and they've inoculated a large part of their population. I think there's I think it's the last gasp in Europe. Developing markets might be a different story. It might be some time, which is what I was talking about before about that emerging markets crisis. If you've still got developing markets still with viruses running rampant and the US dollar running hot, then the potential for an emerging market crisis is there.
Absolutely. Well, we'll keep an eye on it, of course, and I still think that people in Australia don't realise how fortunate we've been here relative to most other countries around the world through the the virus process. The number of deaths, 120,000 deaths in the UK, is a remarkable number, right? And in fact, they're celebrating, quote unquote, the first anniversary of the first deaths in the UK today, and they're actually holding little ceremonies in recognition of the 120,000 who died. So it is amazing that we've done so well, but of course we've got to hang on in there until it's all sorted. Now here's an interesting one which I don't know the answer to, so I'd be interested to get your take on this. This is saying, I would love to hear your thoughts on the shifting of money away from active mutual funds into broader based EFTs over the last few years.
Yes. And so exchange traded funds, just to put that in for anyone, so that basically these are funds which buy which basically just buy the market. There's no regard to what's in it. They just buy one of everything. Well, equivalent market cap, weighted for the size, usually weighted for the size. So I think as a means of accessing low cost investments, I think that's very good. I think for people who are, I guess, disinterested and don't want to sort of, and don't really mind if the value of their price goes up and down, over a period of time, and they're not, the risk return is not of a huge interest, then I think putting the money into ETFs is fine. I think the whole market moving towards ETFs opens up possibilities for active managers to make more profits. I do think it creates a few issues in terms of concentration that mean that we'll probably see more and more volatility within those stocks. So the problem with a lot of the ETFs is they're rules based, and hedge funds and other people love to see those rules based because they can try and arbitrage them, and they know what the rules are. They know what these stocks are going to buy, what these funds are going to buy ahead of time, and they can run the prices up, and you can end up with things like say GameStop, where the pool of GameStop available for people to buy is smaller because, I don't know, let's call it 15%, maybe 20% of the stock was actually held by these index funds that aren't going to be in there buying and selling based on price. So when the price goes up 1,000%, they don't say sell. Whereas a normal sort of more active investor, the price goes up, a couple 100%, they're out there selling their stock. And so what that means is, with fewer active investors, you're probably going to get more volatility, around when you get changes in these stocks. And so, I guess they're price insensitive.
But isn't most of it computer driven? Isn't that the reason why there's more volatility?
I think there's certainly a phase where you'd say a lot of people following the same strategies tends to make more volatility. So you're right in terms of the active. So I guess if we split the market into sort of three parts, way oversimplifying the matter, but you say there's traders out there who are out there buying and selling on price signals. There's investors who are out there buying and selling on their view about the long-term prospects for companies. And then there's index funds and ETFs out there who are buying because that's what the price is. They're indiscriminate about. They're just buying whatever's available without regard to any of the prospects for the companies. Is that if you start seeing a price run up high, then investors will generally be selling, and when the prices fall, investors will be buying. So they're sort of investors will reduce the volatility in terms of dampening the volatility by selling the high ones and buying the low ones. The index guys and the ETFs will be doing nothing to it because they'll just keep on buying the stock regardless, and then the active traders will be increasing the volatility as well because they're trying to buy the stocks that are going up and push them even higher, and then try and time the tops and the bottoms. So if there's 100 stocks out there available, and 70 of them are active investors and 30 of them are traders, then you get a certain amount of volatility. But now if 70% active turns into only 35% active and 35% are ETFs, now the pool of active investors compared to the pool of traders is now it can no longer dampen as much as what it used to dampen, I guess is where I'm coming to from that, if that makes sense.
Yes. And the other thing, of course, is that one of the other reasons why people went down this route was the fees are lower, right?
Oh, absolutely. And so actually, we've got our own product where we're in test phase at the moment on it, just with very low fees that, just for people who just want that index exposure and just want the low fees and the ability to ethically screen the stocks out. So we're in alpha testing at the moment, and so within a month or two, we'd like to think maybe 3 months, 3 or 4 months, we'll be rolling that out for Walk the World investors as well to be able to access those types of funds. But so it's really a question about whether you want the low fees and happy to weather volatility, or you pay a bit more on the fees and we have us trying to dampen that volatility for you, particularly on the downside, is what our pitch is. And then other active investors will pitch that they'll get better performance on the upside and they'll be into the growth funds or quality. So all the active investors have their own pitch on why, but you're really trading off some extra performance for some extra fees for either performance and or risk that you should be getting from your active manager.
Sometimes say you don't get something for nothing or nothing for something, right? So it's a matter of horses. Of course, the beauty of your platform is the choice that you've got, right? So that one of the reasons why we've got the Walk the World Fund is because your ability to be able to offer people choices within the structure and transparent, I think, really makes it stand out.
Yeah, yes, and that's flowing through to what we think we've got a unique bit on the exchange traded funds is you can sort of say, well, I want this exchange traded fund where I've just got the top 40 stocks internationally, but you can say, but I don't want anything to do with coal or climate change, and it'll just say, okay, well, it'll knock out the stocks and you only get 39 stocks. Or you can say, no, I don't want any companies that do animal testing. Say, okay, well, now you've only got 32 stocks out of the 40. So but that idea that you can give ethics are not a science. It's people's own decisions and what they think's right. And so we want to try and put that back in people's hands.
And compare with some of the big funds where effectively it's a complete black box and you get a very limited report, maybe once a year if you're lucky. On your platform you've got much more accessibility of the information, much more ability to flex and change it, and just way more transparency. That's a little bit of a sales pitch, but it's important for people to understand the difference.
Yeah, absolutely. Anyway, we'll go back to the investment side.
Yeah.
But thanks for the Dorothy Dixer question.
Now here's one. Outlook for the Aussie dollar. This is from George.
Near term.
Near term. What do you think?
Look, I think the Aussie dollar, US dollar, it's the US dollar strength that really is going to be the driver over the next little while. So maybe there's another push higher in the Aussie dollar. This is how the Australian dollar goes higher before, but I think the medium, certainly, if your near term is sort of 3 months, then I think the US dollar will be stronger, and so the AUD will be lower. So so it's whatever we are now, 77 cents. It's our view is in the near term it's headed lower, but there's obviously the chances for it to we might not be at the immediate peak, but we think it's close. A lot of this is iron ore based, so I think there's but it's also the amount of stimulus you're seeing in the US, the interest rates in the US. There's a lot of strength coming out of the US that we spoke about a little bit earlier.
Yeah, absolutely, and it's also just worth reflecting on this that the Reserve Bank will quite like the exchange rate lower. Right.
They would love to. At 72 cents, they were talking about it being too high, and they needed to start buying some bonds to get it down, and then we sort of ran up to 80.
And that's the problem, right? So they're trying to keep the yield curve control in place at pinning the 3-year, right? And then they've got the exchange rate, and you've got the US thing going on over there. You could argue that it's quite a tough ask to try and pull both levers and hope they go in the same direction. But just reflect on this, of course, folks, and that is that with the exchange rate at 75, 77, 80, then there's no importing of inflation into Australia. In fact, if anything, we could be importing in deflation, right? And it makes
Yes.
our terms of trade less attractive as well. So for all sorts of reasons, the Reserve Bank would like to see a lower exchange rate.
Yeah, absolutely. And Ross in his book goes into a lot of detail about, a lot of his prescriptions are based around the fact that we need a lower exchange rate to actually get our tradables sector going. So one of the problems we saw in Australia was that the exchange rate went to sort of well over $1 back in the mining boom, which meant a lot of our manufacturing all shut down, and so and manufacturing doesn't turn back on again. So Toyota made the decision at whatever $1.10 to shut down, with the view that actually at 80 odd cents, they would have quite a profitable operation running in Australia. And so if the fact that the way we managed the last boom was to let a lot of our manufacturers go out of business, you actually need the currency to be a lot lower before those companies decide to come back to Australia.
Yeah, indeed. And just acknowledging Master Singleton there and a couple of others who I showed earlier on. Just to explain that when we're in full flight, I will make sure that the super chats show on the screen, even if I don't actually directly acknowledge. But just to say, for everyone who has made a super chat contribution tonight, thank you so much. It is greatly appreciated, and it just helps to cover the cost of doing this. Now, as we come towards the last 10 minutes of the show, I just wanted to pick up one comment from earlier on, and that was relating to the format of the show. You will notice I'm on the other side of the screen. Now, I'm experimenting with this, so tell me what you think, having now got used to it, right? Because the eye line is a lot better when I'm on this side of the screen, when I'm actually speaking sort of, to Damien. So that's the first thing. And the second thing is I've also been able to find a way to animate my globe behind the side by side, right? So my question is, does it work now, having listened to us for a little while? Or do you want me to go back the other one? Because at the start, everyone said, put it back. So I'll be interested to know. The other thing I wanted to touch on was New Zealand, right? So there was a question right at the front, which I can't actually show because we've got too many chats up, but they had made some major announcements today with regards to housing. So they've basically extended to 10 years for investment properties. If you sell within 10 years, they're going to tax you for capital gains. And they also announced a whole bunch of additional incentives to try and help first-time buyers get into the market. Because, of course, in New Zealand, house prices have risen by 23% in the last year on average. Now, it varies by different locations. So they're really quite desperate now to try and actually get this under control. And in fact, the politics of it is that the minister sent a message to the Reserve Bank saying, you've got to actually now put house prices directly into your model and into your thinking when it comes to monetary policy. So reflect on that, Damon, and also reflect on the differences between Australia and New Zealand with regard to house prices.
Yeah, so the first thing I'll start with is the Reserve Bank of New Zealand has got the dual responsibilities. In Australia, it's separated between APRA and the RBA. So, a friend of mine, Jonathan Rockford, who writes, he runs a distressed debt fund and writes quite often. His headline I quite liked from the other day was basically the RBA says the RBA's lit the house prices on fire and saying to the APRA, now you put it out. And the idea is that really what we're looking for is macroprudential tools in terms of 10, 20 years ago, the RBA was, 10 years ago, the RBA was talking about macroprudential tools and saying, no, they're not necessary. It's not something that we need to do. Now, it's pretty widely accepted that these are the tools we need to use to try and keep it down. And that's effectively what we're seeing in New Zealand is, what are the other tools they can put in place? And they have put a few more constraints as well in terms of how much banks are allowed to lend within. So this isn't the first salvo. There's been a few other bits and pieces. So they haven't really worked to date. I think the changes to me are a good thing in terms of it'd be nice that housing is valued most as somewhere for people to live and not as an investment asset. But the issue with falling interest rates is that it turns into an investment asset. So so what's different over here? The RBA doesn't have the mandate for it. It's APRA. They obviously talk, and but the flip side is APRA haven't really been on the if you're going to say which, they seem to be more on the banking side. So there's issues about captured regulators, and I'm not saying, I won't sort of cast aspersions, but I'd say that they certainly sit on the more captured end of the scale than the less captured end of the scale. And so I'm not expecting to see anything sort of brave and unique from the APRA without sort of being pushed. And in particular, we have a government that doesn't want that to happen. They're already trying to roll back the responsible lending laws. So I think we have a very different situation politically. Obviously, there's a fair bit of political excitement on at the moment, and maybe we're in for a different government in a year's time. I think the Labor Party took some strong to the last election, and they're unlikely to do anything except present a very, very small target. And I think making any changes to the housing market after they tried to make some changes to taxes last time, I think is very unlikely. So as much as I think some of these would be great things to come to Australia, I think we have to hope that New Zealand keeps leading the way and actually shows some of these working, because at the moment they haven't really worked that well. Because if they can get them working, then maybe Australia can become infected by these ideas. But we're probably 5 years away, I suppose. The next election probably won't be for another. You think the government will push it as long as they can, which I think is it sort of May next year?
Yeah, I think sort of they can get over into next year if they need to. There was a speculation it would be August this year, but given what's happening at the moment, I think it's going to get kicked out. So
yeah, absolutely. So they'll push it as long as they can. Then the next, even if there's a change of government, you're probably at least another term away from deciding to do anything. So yeah, I think that's unlikely to be here anytime soon, unless it shows that it really, really works well in New Zealand. Which, I mean, I think it'll help at the margin, but I don't think it's a silver bullet.
No, well, it's interesting. Just on APRA. So APRA, of course, has financial stability responsibility, which they interpret as to protecting the banks at all costs. Right, and they've actually said previously what they'd like is a smaller number of bigger banks because it's easier to supervise. Right, so it doesn't give you much in the way of competition. It doesn't give you much in the way of consumer protection. ASIC, of course, is the entity that should actually be providing the consumer protection. The responsible lending bill, which of course got parked, and in fact I did a post the other day on that, calling the SME responsible lending misdirection, because now what's happening is that it got parked because they couldn't get the Senate to actually agree, but now they're using the SME lending argument to try and persuade the Senate crossbenchers to support it when it comes back in May or June. Their argument is, well, it will help us to lend more SME credit, when in fact it won't. It'll go in the opposite direction. So watch that show if you want to know more about it. But this is a big furphy, right? For the fact of the matter is that if ASIC disappears and APRA is actually responsible for regulating everything, that means we're going to get more financial stability, which is just supporting the banks, nothing for consumers. That's a big deal. And unfortunately, that seems to me that what the government wants, listening to what Frydenberg said in the debate and other people. But the debate in the House, and both in the House and the Senate, about responsible lending was huge. There was people on both sides, and it's created real polarisation within the political environment. So I'm trying to give it a kick towards alignment to protect consumers, remembering, of course, that the Royal Commission, Hayne Royal Commission, number one recommendation, keep responsible lending laws in place, right? Yes. And now 2 years later, the government's trying to remove them.
Absolutely. So, I think it's very much that. I guess it's that part of saying, keep in mind, it's a government trying to remove responsible lending. So it gives you a very good idea that they're not going to do a 180 anytime soon on that. But the other part is that the responsible lending laws they're there for those. That's your insurance event. So that's basically to say. It's going to cost us a little bit every day if we have these responsible lending laws, because there won't be as much lending. But on the day that we start to run into a crisis and the sky starts falling, it's going to mean that house prices might only crash 10 or 15% rather than crashing 50 or 70%. So the problem is is that it looks like we're opting about saying, oh no, can we have that little bit? Let's save ourselves that little insurance premium, and when the thing blows up, it's going to blow up bigger. It seems to be the choice we're making at the moment.
Yeah, and it's just worth reflecting on this. This is actually the data relating to the last quarter from APRA, right? Note the big spike in the share of high LVR loans and high debt-to-income loans, right? So we've already got, with responsible lending in play, we've already got a significant spike in relatively bad lending, right? And they're wanting to remove this. It's crazy. It doesn't make any sense at all. It's a doctrinal position in favour of the banks, in my view, rather than actually being good for consumers or indeed the broader economy.
Yeah. So as you can see, like it's gone from what it was 25% to 45%. So it's almost
huge,
doubled the
huge increase, right? And remember that of course is the new loans, right? What's of course happening is we've got a lot of people paying down their loans who've got lower loan to value ratios because they've been repaying loans for years, and people are still actually cautious, right? So you've got this whole bunch of new people, first-time buyers with a 5% deposit, right, and 8 times debt-to-income ratio, coming to the market at a peak. Prices are really high at the moment. They're higher than they've been for a long time. Debt's pretty high as well. It is so risky, and yet they don't think there's an issue. And of course, the Reserve Bank doesn't believe that debt's a problem. They've said several times, it's not an issue because for every asset there's liability, so it cancels each other out. Ping, disappears.
Yeah. That's right, and as Ed said, that's the old economist joke. If your head's in the fire and your feet are in the freezer, but on average you're the right temperature, and it's that it comes back to that's the problem when we have debt crises. Is it is not about the average when there's a debt crisis, and it's exactly the stuff you do every day. Is that all your studies about where the rental stress is, like that's the part. If the average is the same, but there's real extremes, which seems to where we're getting a bunch of people who have plenty of houses all paid off and a bunch of people in real stress, then that's when you have bigger crises.
Well, I'll tell you a quick joke. APRA, senior person at APRA was giving a presentation some years ago. I was listening in the audience. He was using that precise analogy. He was saying, let me tell you a story about 2 economists sitting in a boat, right? And they were trying to shoot ducks, right? And the economist shot in front of the duck and behind the duck, and so they concluded, on average, they'd hit the duck.
Yes.
And he said, that's the problem.
Yeah.
On average, and that is what I keep saying, get granular, got to get granular on all these things. So another good example. Okay, we're nearly out of time. I'm just going to throw this one up. If I can, I missed it, hang on. This was, sorry, okay. Cookie Boy was asking, I think it was Cookie Boy, I've just lost it because of a whole lot of new comments are coming. But anyway, his argument was, the last 2 or 3 months, the stock markets have been wobbling a bit sideways, up and down, having sort of gone up. Is that significant, do you think, or is that just taking breath before we go on again?
Look, I think it's significant. It's particularly in the change in leadership that we're seeing, and that's spoke a bit about the value stocks rotating, and so the stock markets themselves haven't been going far, but underneath there's been a lot of rotation within the stocks that are actually leading or falling. And as you spoke about the Nasdaq, did you say it was 8 or 9% down? Sounds about right. It's sort of close to 10%. Whereas the value stocks are up over that time period. So the question is now, is that something that can continue? And if interest rates keep rising, and we then that's we're likely to see that. We're expecting sometime in the next few months that you'll reach sort of peak inflation fears, and then they're going to start subsiding, and that it'll be there's an opportunity to start changing your portfolio as that's occurring. So we're starting to chip away at that, just because value stocks have run up, and then and actually this part, he's talking about up one day and down the next, and it's even a if you're looking at within the markets, it's also tech stocks one day are up and the next stocks they're down, even which might be different as well to the actual market. So sometimes the actual market will be up and it'll be on the back of tech stocks going down and value stocks rising, The next day, the market might be up again, but it'll be the reverse. And so it is this part about uncertainty where markets are, the bulls and the bears are fighting over who's right in terms of the outlook. So it's certainly it's a difficult time, but I would highlight the fundamentals are very, very good in terms of those earnings I spoke about, and that you really do have a lot of central bank liquidity and a lot of government liquidity flowing through, and so it's a question now of saying, am I happy to buy markets that are a little bit expensive with a view that they might stay expensive for a year, 2 years, at which time they won't be expensive anymore because the earnings have grown so quickly that and I never actually got that opportunity to buy in. That's the discussion we have with a lot of people, is about saying, yes, you do need some defensiveness and you do need to be careful about what you're buying, but there is it looks to me at the moment there's a decent chance that we'll have enough support that you'll be able to bridge the gap until the earnings sort of catch up. And so, not guaranteeing that's the case. We are certainly still trying to look at defensiveness and do we need to sell at certain points, but we need to take that into account. So if you just went to cash today and said, okay, I'm going to wait for the next market fall and then I'll buy back in, it could be 2 or 3 years down the track saying, okay, markets are now higher and economies have recovered and I've missed my chance.
Yeah, and I think it's just worth reflecting on. Nucleus Wealth, of course, has this idea of you need a core of stability in your investment portfolio. You can have a bit of fuzziness around the edge, do a bit of crypto, whatever you want, but it's the core that's really critical, right?
Crypto, but yeah, that's right. I prefer you pick something like a hedge fund or a
hedge fund
debt or whatever else you want to put around, a small caps. But yeah, do your own investment. Have your house. But yeah, you're right. That idea that you want to have some. You sleep at night money that's sort of going, okay, well, I know this is it's core, it's either government debt, it's cash, it's blue chip internationals or blue chip Aussie shares, with the idea that that's but crypto-backed super funds. So do we talk crypto?
Well, I just to say that it was interesting. I did an interview some time ago with one of the organisations who actually sells superannuation related crypto, right? And they said it had a huge rise in it. It's quite worrying, really.
I bet they have, yes. Yeah. Well, look, there's lots of liquidity around, and so I've forgotten the name. Is it NFTs? What's the name of these? All these other ones where people are buying digital pictures for millions of dollars now.
Oh, yes. I can't remember the digital asset thing. Yeah, that's another
so
crazy speculation.
All these are signs about excess liquidity floating around, and that there's lots of money. And so when there's lots of money floating around, people, there's plenty of ways you can dream up to take it away from other people. And so,
well, if anybody wants to buy my rotating globe, just make me an offer.
Yeah, that's right.
Okay, last question for tonight. I think very important one from Madeline is this: do we honestly believe the younger generation coming through will be, on our insane global debts? They're going to wipe it out. Now, it does beg the question: we are stealing from the future, aren't we?
I don't know. I'm not. We're going to get philosophical here, aren't we?
Yep. Look, end of the show. Time for some philosophy.
Yeah. I guess the way I look at it is in a big picture sense, is that we've got this certain amount of productive capacity that's in the economy, and if there's people not working, then we're losing that productivity capacity. So we want to have as many people working as possible. Now, if governments need to fund that so in a way, if governments are saying, well, I've gone into debt in order to make sure I've got more people working today, then for me, for the most part, that's going to pay for itself. Generally, you can definitely piss it up against the wall, and some countries do. But as a broader picture, the more people are working, the better, and that will that'll create productivity, and being included in the workforce will mean that person will probably keep a job rather than dropping out. And the real danger once you lose your job is that you never get back in the workforce. And so now the question is, how do we pay for it? Do we tax people and take that money and then use it? Do we go and print the money and worry about inflation with MMT, or do we go into debt and then people theoretically have to pay it back? I guess one of the things is saying, in a way, what we've done is, if you go into debt but you're paying really, really low interest rates, is you're basically saying to rich people, rather than tax you this money and take it directly from you, I'm just going to give you a very low return on your investments, and I'll take it from you that way. Now, I think it's more efficient to tax people or to print the money and worry about inflation. That's probably more efficient. But the reality is, it's much easier to do it through financial repression. And so, I think the most, as long as we're working towards getting as many people working as possible, as long as that's the goal, and they get the economy as productive as possible, then I'm all for that. And I'm happy to use debt. I'm happy to use taxes. I'm happy to print the money, within reason on each of them. You need to use a bit, good to use a bit of each. The real way out is inflation and getting wage inflation, because as anyone who grew up in the 70s, will say to you, and then bought houses in the 70s and 80s, they'll say, well, I bought a house for $10,000 and now it's worth, millions of dollars. And what they neglect to tell you as well is that, their wage at the time was $5,000 or $10,000 as well. And so, and that's the bit that's grown. And so if you can get growing wages, then the debts don't matter as much, because they'll come off.
Yeah.
I need to work on my
Oh, you're doing pretty well. And thanks very much for all the very positive comments on the conversation. I found this a really stimulating chat today, and I always do when you come on. We've covered a whole range of things. I have a bunch of other questions we didn't get to, but that's just the way it goes. So I really appreciate your time tonight. Thank you very much for sharing your thoughts. If people want to find out more about the Walk With World Fund, just go to walktheworld.com.au. It's all there, and you can go across and see all the stuff that Damien and co have there. I've had to say we've got a really good take-up, and a lot of people have been very pleased with the interaction with Nucleus. So I think it proves that the working together on this stuff has actually proved pretty useful. Particularly, as we've said previously, it's important to get some market exposure given what's going on at the moment. So there we go. All right. So thank you. Any last comments before we sign off?
No, I think I'll leave it at that. We've covered enough topics.
Well,
I've probably upset enough people already.
Well, that's okay. That's part of the fun. Thank you very much for your time once again. We're going to get you back on next month, of course, as well. And I look forward to that. And meantime, take care and keep well. And I'll just take you out now and sign off on the rest of the show. Great. Well, there you go. Thank you very much for spending some time with us. Damien's a great guest as always. Just to tell you that next week we're going to be talking Brisbane property with Megan Wells, a very well-known real estate and property buyer in Brisbane. I've had a few people say, talk to me about local property, and so we're going to talk about the Brisbane property in detail, and I'll be able to get some of my data up as well just to explore that. So mark your diaries next week. And got a few other guests coming, of course, as we move into April, but that's the one for next week. So, of course, interestingly, this was a 5-Tuesday month, so you get an extra show. So I want to say thank you very much for spending some time with us this evening. Really appreciated it. Really appreciate all the questions and all the chat. Sorry I didn't get to every single question. Thank you for everybody who made a specific contribution via the super chat. Really is appreciated. And I'll look forward to seeing you on the show this time next week. Meantime, there'll be more shows coming out over the next few days. Got a whole bunch of stuff which we're covering at the moment. Watch out for that. And once again, I look forward to talking with you again soon. Thank you for your time tonight. Take care. Have a good evening. This is Martin North from Digital Finance Analytics, signing off.